And we are now official. Thank you for coming out this morning to join me here. This is Pacific Trading Academy's presentation of Mentor Mike Bridges' Elliott Wave, Just the Essentials. It is Saturday, April 19th, 2014, and it's about 9 a.m. here on the West Coast Pacific time. So let's get started. For those of you who don't already know me, I'm a California lawyer who has specialized in financial planning. I've held a number of FINRA licenses, including Series 3, Commodity Futures and Options, Series 7, General Securities, and Series 66, Investment Advisor. I've also helped my clients with planning involving insurances, so I've had licenses for life, accident, health, and variable contracts. But one of the things that I've really enjoyed doing for most of my adult life has been trading the markets, learning about the markets, and teaching other people about the markets. And I've been doing that since 1984. Excuse me. And if you're not too good with math, that's 30 years, folks. So I've had 30 years of experience trading the markets. I've also been teaching other traders in stocks, futures, and Forex since 2000. That's another 14 years of experience as a teacher. I was first registered as an NFA CFTC commodity trading advisor back in 2003. My favorite method in market is to day trade the S&P E-mini. My favorite platform is NinjaTrader 7. The charts that you see in today's presentation are from NinjaTrader. And my favorite broker is Trenton Kimino of Global Futures right here in Southern California, Encino, California. Now, I am a member of LinkedIn. That's my extent of social media exposure. But if you happen to be a member of LinkedIn, you can check out my profile. I do a lot of postings there on an almost daily basis about my personal trading, the trading done by my students, and also upcoming presentations like this one. So if you're LinkedIn, check me out. I also maintain a regular blog on the Pacific Trading Academy website, and you'll find that at pacifictradingacademy.com. Go to the blog link here, and then select Mentor Mike's Market Movies. And I have been doing this for a long time, and so we have quite a sizable archive there. Access is completely free, and there's a lot of good information there, including past webinars like this one that we're doing today. So check it out when you get a chance, and hopefully you'll find something of value there. Now, how do you eat an elephant? Well, that's an old riddle you've probably heard before, and the answer, of course, is one bite at a time. But I like to start off with that because that kind of summarizes my approach to learning how to trade and teaching others how to trade. Any large task, like learning to trade, can seem overwhelmingly difficult at the outset, but the key is to break it down into manageable chunks and then just get started. So we can apply this proven technique when attempting to make sense of the chaotic motion on a price chart. And another fellow who kind of took this approach is this guy here, Ralph Nelson Elliott. You can see his dates, 1871 to 1948. Now, in the early 1930s, Elliott began his systematic study of 75 years of stock market data, including index charts with increments ranging from yearly to half-hourly. In August of 1938, he detailed the results of his studies in his book entitled The Wave Principle. Elliott stated that while stock market prices may appear random and unpredictable, they actually follow predictable natural laws and can be measured and forecast using Fibonacci numbers. And folks, as a student of Mr. Elliott here, I can tell you that I have seen plenty of evidence over the last 30 years that he was definitely on to something real. Now, there are some resources out there that are available to all of you completely free of charge. This is a screen capture from the homepage of a website called elliottwave.com. And as you can see, there is a link for free resources and education. And if you check out that website, I'm sure you'll find some valuable info that will help you with your Elliott Wave education. There is another website related to Elliott Wave called socionomics.net, and the operator of this website, who also runs elliottwave.com, is a fellow by the name of Robert Prechter, who is probably the foremost guru of all things Elliott Wave alive today. He's about my age, in his mid-60s, and he has taken the idea of the Elliott wave pattern to kind of another level, and he says that the pattern is not just found in the stock market or even just in financial markets, but can actually be found in all sorts of human activities where a bunch of us get together in a big collective endeavor. And it's kind of an interesting theory, and he makes a pretty compelling case for it. And so what I recommend all my students is come to this website, go to the basics link here, and just read a little bit about the socionomics theory of Elliott wave application. There's also a link on that page to a video called History's Hidden Engine, and I suggest all my students that they check that out. It's an hour-long video. It's kind of well done, I think. Reminds me of something that you might see on the History Channel or the Discovery Channel. And it explains the socionomics theory, but of course, in order to do that, the viewer has to know something about Elliott wave theory. So it gives you a little background in Elliott wave. And since Elliott wave is predicated on Fibonacci numbers and ratios, it also gives you a nice background in Fibonacci. So it's a great way to kind of be brought up to speed on Elliott wave in general, and it's pretty painless to do. I know for myself personally, I always get a lot out of watching videos. There's something about the combination of visual input and auditory input that seems to work better for me than simply listening to a lecture or reading a book. So if you're anything like this, this will be a great place to start in your Elliott wave education. Now, this is the front and back covers of about a 40-page pamphlet that came from the Elliott Wave Institute. This is the guys that sponsor elliottwave.com. I don't remember if I bought this separately or whether it came with a DVD course that I bought on Elliott Wave, but it's a great little source of basic information on the Elliott Wave principle. And here's the inside cover. You can see there is an address in Gainesville, Georgia, and some telephone numbers and fax number and so forth. I'm sure you can find information about how to contact these folks from the elliottwave.com website if you're interested in getting this little pamphlet. Now, let's get right on into it here. The various types of waves. There's motive patterns and there are corrective patterns. Motive patterns move in the direction of the trend on the next higher time frame. They're constructed of 5 waves, and there are 2 kinds of motive patterns. The impulse pattern, which is the most common, and then there's also the diagonal triangle. Diagonal triangles are usually found in the 5th wave position when you have your basic 5-wave motive pattern. Now, motive patterns are relatively easy to recognize. That's the good news. But then we come to the corrective patterns. Corrective patterns move against the direction of the trend on the next higher time frame, and there are 4 basic categories: zigzags, flats, horizontal triangles, and combinations. There are numerous subtypes. Simple corrective patterns have 3 waves. Complex versions can have 13 or more waves. If you have absolutely no clue what's happening, you're probably looking at a corrective pattern, but that in and of itself can tell you something. Now, another aspect of Elliott is the notion of fractals and Fibonacci. Now, most of you are familiar with Mr. Fibonacci. He's that youthful-looking gentleman with the stylish dish towel on his head there over on the right side. He discovered a sequence of numbers and the ratios related to those numbers. He wasn't the first one to discover that, because we know from the art and architecture of many ancient societies that they were onto it as well, but the knowledge kind of got lost in the Middle Ages, and Fibonacci rediscovered it. And What happens, of course, in the Fibonacci sequence is each number is the sum of the preceding two numbers. And Elliott was a big fan of Fibonacci, and so it's not a big surprise to learn that his Elliott wave theory is predicated on the what he believed to be the objective reality of Fibonacci numbers and ratios in the market. Now, the little diagram that you see over here on the left, I did myself some years ago, and this relates to the fractal nature of Elliott wave patterns. Now, the term fractal didn't come along until the 1970s, but the idea is that in a fractal geometric pattern, you have a pattern that's made up of smaller versions of itself and is at the same time part of a larger similar pattern on a higher time frame. So here, if you look first at the black lines, you can see we have a 5-wave impulse pattern, 1, 2, 3, 4, 5, followed by a classic ABC zigzag pattern, ABC. Now, if you found that on a price chart, you would also discover that it is part of a larger pattern on a higher time frame. And in this example, I suggested that this might be wave 1 and 2 of a much higher time frame. However, the magnification can go in both directions. And so just as our black lines are part of a larger pattern on a higher time frame, they too are actually made up of smaller patterns on a lower time frame. So you can see here with wave 1, it wouldn't just be one straight line. It would actually be made up of an entire 5-wave pattern on a smaller time frame. And then we have our ABC for wave 2 and so forth. And the same is true of our corrective waves. In a typical zigzag pattern, A is made up of 5 waves, 1, 2, 3, 4, 5. B is 3, A, B, C, and C, once again, is made up of 5 waves. So this is the fractal aspect of Elliott wave theory. Getting back to our friend Mr. Fibonacci, some of these extensions and retracements will very typically be Fibonacci ratios. And the two big ones are, of course, 61.8% and 38.2%. Together, they add up to 100%. And so it's very common to see these ratios in Fibonacci patterns, and we'll be pointing that out as we go along. Now, Elliott wave rules. These rules are supposed to be hard and fast and inviolable and found in every single case of a Elliott wave pattern. These would then rise to what I call cosmic truths of trading. In reality, there are just these 3. First of all, wave 2 cannot retrace more than 100% of wave 1. The second rule is wave 4 cannot retrace more than 100% of wave 3. And our third and final rule is that wave 3 cannot be the shortest motive wave. Now, let's go into a little more detail on the third rule there. It's waves 1, 3, and 5 that are the motive waves. So wave 3 must be longer than either 1 or 5, but it doesn't necessarily need to be longer than both, although it frequently is. Now, many of you have probably heard this as a rule, that wave 4 cannot enter the price territory of wave 1. But it is not, I repeat, not a universal rule. And the quote below is what Robert Prechter, the expert, actually says about this. This rule holds for all non-leveraged cash markets. Futures markets with their extreme leverage can induce short-term price extremes that would not occur in cash markets. Even so, overlapping is usually confined to daily and intraday price fluctuations, and even then is rare. So basically he's saying this rule, supposed rule, is really only a rule in time frames higher than the daily, because he says that you can get overlapping in daily here. And the place where the overlapping is most likely to occur is going to be with intraday futures. Well, folks, that's exactly what I trade. The S&P E-mini, of course, is a futures, and I'm a day trader, which means I trade it intraday. So it's entirely possible for wave 4 to enter into the territory of wave 1. Now, in defense of Mr. Prechter here, this quote came from his full-on book, which was published in 1978, which is a good 20 years before the advent of electronic day trading. So there wasn't a lot of data available on Elliott wave patterns in intraday trading. So I think that based on what he had to work with at the time, he's pretty spot on most of the time. All right, continuing on. In addition to rules, there are Elliott wave guidelines. Now, Prechter says that guidelines are typical yet not inevitable characteristics. Now, the ones I follow are these: extension, alternation, channeling, ratio relationships, and truncation. Now, let's look at each one separately. Extension. This relates to our motive waves, 1, 3, or 5. They can appear noticeably longer and with more prominent subwaves. These subwaves can sometimes rival the size of the waves in the primary pattern. And in our example here, you can see we have a 1, 2, and then an elongated wave 3 with some very obvious subwaves within it, subwaves that are even big enough to flip our red parabolic modules here. So we'll get a chance to look at these charts in much greater detail in just a moment. Now, any of the motive waves can be extended, and sometimes you can even have more than one in the same pattern. But it's wave 3 that extends the majority of the time. All right, let's take a look at alternation. Alternation relates to the corrective waves, which would be waves 2 or 4. Now, if one of the corrective waves is a simple zigzag, the other one will tend to be a more complex form with more prominent subwaves. And as with extensions, these subwaves can be sometimes the size of the waves in the primary pattern. In my experience, wave 4 is more often the complex one, but in this particular example, it happens to be wave 2. So here you can see 3 and 4 are simple zigzag, whereas wave 2 is a more prominent A, B, C. And again, we'll get to see this much closer up in just a bit. All right, also, we have a guideline relating to what's called channeling. An Elliott wave pattern, both motive and corrective waves, will tend to fit within a regression channel. Now, a regression channel is a drawing tool that has essentially kind of a self-correcting moving average that as you draw it over the price, it repositions itself constantly to sort of end up in the mid-range mathematically between highest highs and lowest lows. And then it also draws an upper and lower channel line that is a certain number of standard deviations above and below that self-adjusting moving average. And you draw it between the pattern's starting point, which is usually the highest high or lowest low on one side of our trend-defining moving average, down to the end point of the pattern, which is highest high or lowest low on the other side of our trend definer. So in this little chart here, the dashed green line is my trend-defining moving average. And if you've seen any of my other webinars about my charting style, you'll know what that is. The patterns always begin on one side and end on the other side. That's one of the values of having that trend definer there. Now, when the price breaks out clearly and unmistakably from the regression channel, that signals that the original pattern has completed and a new pattern in the opposite direction is beginning. So we'll see this one up close in a minute too. Now, what about ratio relationships? Remember that Elliott wave theory is built upon Fibonacci numbers and ratios. For example, there's the 5-wave motive pattern and the 3-wave corrective patterns. 5 and 3, of course, are Fibonacci numbers. Now, if we consider the entire length of a 5-wave motive pattern to be 100%, and here I've drawn this long yellow line here from the top point starting position of the pattern down to the bottom end point of the pattern. If we consider that distance to be 100%, we will frequently find that the distance from the start of the pattern down to the end of wave 3 is about 61.8% of the total. And wave 5 then makes up the remaining 38.2% of the complete pattern's length. And that's pretty much what we've got here. Wave 3 went just a teeny bit beyond the 0.618 barrier, and then the first correction in our extended wave 5 came right up and hit that same point from the underside. So you can see that you're going to get this separation quite frequently, where you got basically your 61.8 on top, 38.2% on the bottom, at least with a bearish pattern, and the other way around if you have a bullish pattern. Then we have the Elliott wave guideline of truncation, which says that sometimes wave 5 may not exceed the end of wave 1. And in our example, you can see wave 3 is the lower wave here, and wave 5 ends a little bit short of having taken out that low. Now, I believe that truncation can happen, but is extremely rare. So before I apply it to any wave count, I try to make sure that there is not another possible wave count that does not need truncation. And frequently that's the case. Now, how do you get good at this? Obviously, you got to practice. Any kind of skill involves practice and repetition. And before you start worrying about trying to figure out where you are in the Elliott wave pattern in a live, real money trade, you got to spend some time practicing your wave counting, and preferably outside the heat of battle after the market is closed. I recommend that you practice your wave counting after a pattern is fully completed, because after all, you must know what Elliott wave patterns look like in their finished form before you can ever know where you are while the pattern is still in the process of forming. I recommend that you start at the ends and work toward the middle. Now, based on the fact that wave 3 is the most likely of the motive waves to be extended, you can assume that the first zigzag is probably waves 1 and 2. And likewise assume that the last zigzag is probably waves 4 and 5. Everything in between is probably wave 3 and its various subwaves. You want to use the momentum modules of the red parabolic SAR whenever possible. Of course, that assumes you're using my red, white, and blue setup, but why would you not? It works very well. You can then test your wave count with channeling and ratio relationships. Now, any wave count that does not break a rule or grossly violate a guideline is potentially the correct wave count. Now, after writing this, I thought about changing it because I'm saying potentially the correct wave count, which kind of suggests that there's only going to be one correct wave count. That's not necessarily the case. I have encountered situations where you can have a slightly different wave count, and in each case you're not breaking any rules and you're not violating any guidelines, and so theoretically either of those could be a correct wave count. So don't think that there's only one answer to this particular problem. Now, this is one of the aspects of the points of criticism that Elliott wave frequently gets. People dislike its complexity, and people particularly don't like the fact that it's totally subjective. There is nowhere we can go. There is no carved in stone objective standard in the cosmos where we can look and compare our wave count and determine whether we have it right or not. We have to just do our best and make sure that if we're not breaking a rule and violating a guideline, then our count is as good as anybody else's, basically. Now, you've seen a lot of verbiage here. Let's see how it actually works in actual practice. All right, so here we have a big bearish pattern, as you can see. And remember, my suggestion was to start from the ends and work in towards the middle. So here we have what appears to be the beginning of this bearish pattern. It's the highest high above our trend-defining moving average, and down here is the lowest low. Now, notice that this happened to be on a Friday afternoon, and the price had not yet broken above our trend definer, so it was theoretically possible at this point that the market could still go lower. In fact, it didn't, and this did end up being the lowest low. But I'm just pointing that fact out because usually you can't say that something is the highest or lowest point until the line of demarcation has been crossed, which we didn't actually have here. But in any event, I'm going to figure out what the Elliott wave count on this pattern is, and I start by taking the first drop across the trend definer and calling it wave 1. And of course, the lowest low is going to be wave 5. Let's proceed from there. Well, the first zigzag up from 1 is this one here, but we can see that the price quickly comes down and goes up to a slightly matching high here. And so chances are that wave 2 can actually be labeled at the second point, and what we have is a classic ABC correction here. Now, if 5 is down here and our first zigzag is typically 4, then 4 would be right here, and we can see that we have a very simple corrective move without any obvious subwaves here. And as I said earlier, it happens that my experience is usually that wave 4 tends to be the more complex of the two corrective waves, but it doesn't have to be. In this particular example, it looks like wave 2 is going to be the complex one, and wave 4 is the simple one. All right, so far so good. Now that means that what's left over is probably going to be wave 3 and its subparts. So let's see how that works out. Well, if this is wave 4, this has to be wave 3, and we can see we've got some nice subwaves carved out by our red parabolic. We got 1, 2, 3, 4, 5. Okay, so far so good. We obviously have an extended wave 1 of 3 here, and that's okay. It can be the extended wave. The problem, though, is our wave 3 of our big wave 3 does not appear to be bigger than the other two. And remember, wave 3 cannot be the smallest of the motive waves. And that is a rule that applies not just to the primary pattern, but to your subpatterns as well. So let's measure and see if this is going to work out. Excuse me. And that's unfortunately a problem. Our wave 3 turns out that it is the smallest of the motive waves of the wave 3 that we have labeled currently. So you know what? This cannot be the count. Now, wave 1 and 2, that's probably okay. Wave 5 up to wave 4, that's probably okay too. But this cannot be our wave 3 because the subwaves just don't allow it under the rules. So let's try a different count. Now, if we move wave 3 up to this point here, we still have a simple correction for 4. And of course, we have our complex wave 2. So we've maintained the guideline of alternation. We also appear now to have 2 extended motive waves with very obvious subwaves. Here's 1, 2, 3, 4, 5 for wave 3. And then wave 5 is also extended, and in its case, we actually have the subwaves carved out and segregated by our red parabolic here. Now, there's nothing that violates any rules or guidelines here. So far, so good. Now, what we do want to do is test our waves 3 here and make sure that they are not the smallest of the other motive waves within those particular patterns. So let's take a look. All right, this wave 3 of 3 is shorter than 1, but it's larger than 5, so it's okay. And in our extended wave 5, wave 3 is bigger than both 1 and 5, so it's okay too. Well, so far so good. Let's try the regression channel and Fibonacci grid tests. And lo and behold, we fit within the Fibonacci channel. There's a little minor excursion outside the channel at waves 1 and 2 and 3, and that's okay. The bulk of the price activity fits within the channel, and we can see that when we break out after our wave 5, the price never again re-enters that regression channel. It takes off in the opposite direction, and therefore we have a very high probability that this is the finished pattern and our wave count is correct. Now let's try the Fibonacci grid. If we draw it from the start of the pattern down to the bottom of the pattern, here's our 61.8% line. Wave 3 goes just a tad bit below it, but it's pretty close. And notice that wave 2 of 5 comes up right to it. So the upper portion is our 61.8 and our lower portion is the 38.2. Pretty darn close. A classic division, Fibonacci division in the Elliott wave pattern, and therefore I would go up against anyone and say that this is a valid pattern. Is it the only one? Perhaps not, but this one works. It does not violate any rules, and it does not run counter to any guidelines. All right, so far so good. Let's get a little more practice in. Now, here's a more complex fellow. What it looks like is we've got a down move followed by a corrective bounce and then a resumption of the down move. And sometimes a very simple way to kind of start the process of simplifying the mess on the chart is just with some directional arrow lines. So in this case, we can see that we've got essentially down moving price activity underneath a down sloping trend defining moving average. And then after that, we get what appears to be a corrective bounce above a now slightly upsloping trend defining moving average, followed by a resumption of the downtrend shortly thereafter. So how can we approach this problem in a systematic way? Well, what I would do in this instance, since we've got kind of half of one pattern, a full correction, and then what appears to be a full impulse pattern leading away, I would start kind of in the middle, and I'd first work backwards to the left and then go back to the middle and go to the right. So if this is the end of our corrective bounce, there is a pretty good chance that this is a wave C. We label corrective waves with letters, A, B, C, D, E, etc. We label impulse waves with numbers. And so it's possible to have a corrective pattern that ends with perhaps an E, because you can have 5 wave corrections, and you'll see that in just a bit. But there's a real high chance that this is a wave C. So one of the things I can do is I can start here and count backwards and see what that gets me. So C, B, A, and then 5, 4, and then this is the lower low than this one. So this is probably wave 3, and we may have an ABC for wave 4 here. But what about this? This correction for B wave actually takes out the low of wave 5. Wouldn't that make this a better candidate for wave 5? Actually, no. This pattern appears to be what's called a flat. And in a flat, wave B can actually exceed the end of wave 5. Now, in a flat correction, the subwaves are counted 3, 3, and 5. So let's apply some subwaves here and see if that's going to hold true. And apparently it does. We've added A, B, C for our wave 4 here. No well, you can see the subwaves of wave 5, but we're really concerned with the corrective pattern. A appears to have a fairly prominent three-wave pattern, A, B, C. B also does, but it's a little lower down, A, B, C. And we have a very obvious five-wave subwave pattern on C. 1, 2, 3, 4, 5. So it looks to me like we're okay up to this point. Now, we're not worrying about what transpired before what's shown on the chart there. Trust me that I did take a look at it, and everything you see here is consistent with what went before. Now we want to work on putting together the proper wave count for what takes place after wave C. Well, as before, we start from the ends and work in. So first major zigzag, and we're going to use the red parabolic whenever possible, remember. So here's 1 and 2, and then the bottom, of course, would be wave 5, and the first zigzag is wave 4. Well, I'm already starting to see some problems here, but let's move forward and see where we get. If this is wave 4, this has got to be wave 3. But what the heck is this? We've got a very substantial zigzag here, big enough, in fact, to flip our parabolic. And it's all by itself. If this is 1 and 2, what the heck is this? Well, it doesn't fit. So there's a real good chance that this is not our count. So let's try something a little different. Well, first, apparently, we want to measure and just verify if the length of wave 3 is also an impediment here. The magenta line in this slide represents the length of wave 3, and then the green here is wave 1, and the green here is wave 5. Well, you can pretty much almost eyeball it that wave 5 is longer than 3. These two lines look pretty similar, but trust me when I tell you that if you actually measure the length of 1 and 3, it turns out that wave 1 is at least 1 or possibly 2 ticks longer than 3. So we have the same dilemma we had in the other example, namely, our subwave 3 can't be it. It's not going to work. So this is not a viable pattern. What if we do this? What if we move wave 3 down to this point, make this wave 4, and we have a truncated wave 5? How's that going to work? Well, it might. Notice that we have a simple zigzag for wave 2, but we have a more complex ABC for wave 4. Now, you heard me say I don't like truncated wave 5s, but let's put in some subwaves and see how that might fly. Okay, this part we saw before. Now you can see wave 1 has a 5-part structure, 1, 2, 3, 4, 5. This wave 2 actually has a modified ABC as well. And then we have 1, 2, 3, 4, 5 for our wave 3. And it makes wave 3 the extended wave, which is what we would expect most of the time. And we can also tell by eyeballing it that our internal subwave 3 may not be longer than 5, but it's clearly longer than 1. And consequently, this works as well. But what about the truncated wave 5? Well, notice I have a question mark there. And the reason for that is that, once again, this happens to be a Friday. And until the market reopens on the following Sunday afternoon, and we see what happens, we don't know if the market might go lower and eliminate our truncated wave 5. But I think the odds are pretty good that down to wave 3 and 4 were correct. Now, let's test it out. We fit within the trend of, or excuse me, we fit within the regression channel. Once again, there are small excursions on either side for 4 and 3, but that does not negate the fact that the vast majority of the price activity fits within it. And if we draw our Fibonacci grid down to from the highest high to the lowest low, our 61.8 and 38.2% falls right at the wave 3 level once again. Now, this is a typo. This should be 61.8, not 62.8, but hey, it's probably late while I was doing this. So we pass the regression channel test and we pass the Fibonacci grid test for as far as it goes. But we still don't know if this thing is going to be a truncated wave 5 and the market's going to go up from here, or whether it's going to drop down further and give us a wave 5 that actually does take out wave 3. Well, once the market opens, did I go backwards? Yes, I think I did. Here we go. When the market opens on Sunday afternoon, the price continues to sell off. And it doesn't go as far to, oh, I know what it was. Hang on, back up just one second. I was saying that one thing we could do here, here's our Friday chart once again. And if we put the 61.8, 38.2 grid on here, making the bottom of our wave 3 at 61, the possibility exists that wave 5 could go all the way down to here. Because here's the 100% level, here's the 61.8, and here's the 38.2. So is it possible that the market, when it reopens, is actually going to sell off all this way down and give us this big old extended wave 5? Maybe. I'm not real convinced. My gut feel says it might go lower, but not that low. But this is possible where it could end up. Now, here's where it actually ended up. It did sell off some more, but it didn't go that far down. It stopped short of that, but it did provide us with an extended wave 5. You can see we have 1, 2, and now we know that this is 3 and 4, but you can clearly see the subwaves of wave of 5 of 5. We have 1, 2, 3, 4, 5, 5, 5. We've got 3 levels of 5s right there. We now fit again within the regression channel test, but our Fibonacci ratio is a little bit different. Instead of 61.8 and 38.2, we have 76.4 and 23.6. Now, where do these numbers come from? Well, if you take 61.8 and subtract 38.2, you get 23.6. And if you subtract 23.6 from 1, you get 76.4. Now, these happen to be the overbought and oversold zone ratios that I use on my stochastic. But it's not as prevalent as the 61.8, 38.2, but it's still a valid Fibonacci ratio that shows that even though the completion of this pattern was separated by an entire weekend, it still ends up coming in without violating any rules or guidelines. Now, let's continue our practice. Here is a 5-minute chart where it's sometimes easier to do a little gross wave counting. So we've got a 3, 4, 5. This becomes the lowest point below the trend definer on this time frame. So when we break above it, we have 1, 2, 3, 4, 5, and then what I believe to be a wave A up to wave B. Now let's look at this area on the right-hand side in greater detail using a 1-minute chart. And here is what that looks like. So we have wave 3, 4, 5. Here's wave 3. We drop down to wave 4. And it looks to me like there are 5 subwaves here, A, B, C, D, E. Well, the 5 subwave pattern, when it's applied to a corrective pattern, is sometimes what they call the triangle version. But it doesn't have to be completely triangular. But the bottom line is that subwaves, or excuse me, that corrective waves can have a 5-wave pattern, A, B, C, D, E. Then we have 1, 2, 3, and then our wave 4 of this wave 5 pattern is got the classic ABC correction, up to wave 5, which is a little bit higher than wave 3. So we have 3, 4, 5, and then this drop here is definitely a corrective wave. And notice how the very obvious parabolic momentum modules have been carved out. We've got 3. 1, 2, 3. And my best wave count under those circumstances would be a pattern called a combination, specifically a double 3 combination. A, B, C, X, A, B, C. That's how you count it, and that's how this wave comes down. Now, let's do another one from scratch. We've got what appears to be perhaps a bearish impulse pattern. And let's do our basic put together here, where we come from the ends in towards the middle. We start with the highest high above the trend definer, and we end with the lowest low below the trend definer. So it sure looks like a bearish pattern on its face. And once again, we start from the ends and work in. So 5, first zigzag up is 4. Here's 1, first zigzag up is 2. Now, we can already kind of see that wave 4 looks pretty complicated, relatively speaking, and wave 2 looks pretty simple. Although, check this out. Wave 1 begins at this upper Donchian channel line, and wave 2 gets right up to it. In other words, this wave 2 has retraced exactly 100% of wave 1. The rule says it can't retrace more than 100% of wave 1. It can retrace exactly 100% without violating that rule. Now, is this common? Not so much, but it's still a valid wave count so far. So we've got 1 and 2, 4 and 5. Let's put the rest together. And remember I said we want to use the parabolics as much as possible. And literally in this case, every single wave and subwave has its own parabolic module. So there's 1, 2, and then we have 1, 2, 3, 4 of, and 5 of 3. And then with wave 4, we have a nice A, B, C. So no rules violated. We have the guideline of extension present. We have the guideline of alternation present. And I submit to you that that is certainly a valid wave count for this particular pattern, if not the valid wave count. Let's see what else we can do. Now, let me go back real quick. We're going to continue on from this pattern here. We're going to start from R5, and we're now going to move forward in time to what happens after this. So here's our wave 5. It's a little more compressed than it was on the other chart. But now you can see we move up to what turns out to be wave 3 of a larger pattern. So here's 1, 2, and then we have 1, 2, 3, 4, 5, wave 3. And here is a 5 wave 4, A, B, C, D, E. That's wave 4. And incidentally, remember this is wave 4 of a larger pattern, so it doesn't enter into the price territory of its wave 1, even though that's not a critical rule, but just to let you know. And up we go to wave 5. Let's continue on then. Here's that same wave 5, and we get another double 3 combo correcting ABC, XABC, and up we go again. Look at all of the extended waves and the very obvious subwaves. We have 1, 2, 3, 4, 5. There's wave 1. Simple wave 2. Then we have 1, 2 of wave 3, and 2 is a little more complex here, A, B, C. We go up to 3, down to 4. Simple wave 4 of wave 3, so we have the guideline of alternation. There's wave 5 that completes wave 3. Now we have A, B, C, and its own parabolic module for the wave 4, and we have even an extended wave 5. 1, 2, 3, 4, 5. And there we are with a new wave 1 of a brand new pattern. Now, if you'd like to be able to trade like we do using the red, white, and blue momentum modules and the Elliott wave counts that we use in our trading room, I urge you to think about becoming my student. If you'd like to find out more about that, go to PacificTradingAcademy.com. You're going to go to the enrollment link, and then Mike Bridges' mentoring course and trading room on this first page. You can learn all about it, including the course outline. When you're ready to check out the cost and payment plan, you hit this blue button right here, and you're taken to this page. It's a 3-month course. It has videos, live sessions with me, and a twice-a-week live trading room with me and your fellow students. The total tuition is $4,990 payable in these 2 installments, $29.95 followed by $19.95 a month later. All you got to do is fill out the form, put in your credit card information, and we'll be in touch with you, giving you the information on how to log into the trading room, how to access the videos, and to set up the first meeting between you and me. Now, here's a quick summary of what you get. In 3 months, you have access to 9 video lessons. You get 12 one-on-one phone conferences with me, 3 months of access to our twice-a-week trading room, and you'll have the option of extending your time in the trading room on a month-to-month basis if you desire. The all-inclusive tuition is $49.90, payable $29.95, and $19.95 in 30 days. If you want to extend the trading room time, it's $100 a month. If you're a Pacific Trading graduate, and you don't have to be my student, you can be a student of any of the mentors, you too can subscribe to just the trading room for $100 a month. Now, another thing that my students get, and which anybody can get if they so desire, is my daily market updates. We talk about whatever trading I did personally, what's coming up. There's always screen captures of charts attached. So sometimes I show my charts, sometimes I show, in addition, charts by my students. If you would like to receive this so that you can follow the progress in my current crop of students, I'll be happy to put you on the mailing list. All you have to do is let me know, and I'll give you my email where you can send that request in just a second. But this is one aspect of the course that anybody can receive. Now, I call my particular group of traders Gadget. That's the Grand Day group of E-mini traders. I can make no guarantees, but my personal goals are these: to help every student become a competent and confident trader with a win percentage of 90% or better, to help most students earn enough to pay for the course within 3 months, to help some students earn $1,000 per day or more within a year, and to help a few students earn $1 million within 5 years. I am serious. Are you interested? If you are, there again is the link for enrolling online. Now, $1 million in 5 years? Seriously? Well, if you make $1,000 a day, you're going to be earning approximately $250,000 a year. So $1 million in 5 years is not unreasonable if you can maintain that kind of daily average. So the real question is a grand a day a realistic goal? Well, folks, I am here to tell you that it very much is. I earn my grand a day pretty much every day, and oftentimes even before the day session opens. I do it in the pre-market. But the real question is, can I teach my students to do it? And I'm proud to announce that just about a week ago or so, we had our first official member of Gadget. Greg O. of Florida earned $1,000, over $1,000 in a day on real money trades, and he's done it at least 3 times to my knowledge. So he's our first official Gadget member. We actually have the premium Gadget members who are doing it with real money, and we have the junior members who are doing it with on the demo platform. But the idea is it can be done, folks, and you need to have a goal that is going to be worthy of you. And I'm here to tell you it can be done. Now, if you got questions or comments for me, Mentor Mike, or you want to get on my daily update email list, you can reach me at mentormike@sbcglobal.net, and please include your phone number and time zone. Better yet, become my student and enroll directly online, and there once again is where you go. PacificTradingAcademy.com, enrollment link, Mike Bridges mentoring course and trading room. Now we got a little bit of time remaining in our hour, so let me see if any questions have been asked here. I need to close up my little okay. Well, I don't know if I'm doing something wrong here, but I don't see any questions. So I'm going to allow you folks to send me your questions at mentormike@sbcglobal.net, and I will do my best to get back with you just as quickly as I can. And so I hope you found something of value here today. And I look forward to getting with you again real soon. Check my blog page, check my LinkedIn profile, and you'll get information about our upcoming presentations. All right. Thank you very much. Everybody else, have a wonderful rest of the weekend. Bye-bye for now.